Welcome to the InterMarket Analysis video update. This is a video that I do once a week where we look outside of the S&P 500 at other indexes within the stock market. And I also look at other markets because sometimes we can get some clues as to what's happening ultimately with the S&P 500 because no market exists in a vacuum. There are different pushes and pulls that can have an influence over stocks. This is being prepared for Monday, October 9th. The first area that we talk about is S&P 500 valuation. Is the market considered to be expensive, inexpensive, or fairly priced? We look at that on a historical basis by looking back at what the earnings were previously. We get an idea where we're at right now, and then we also project things into the future because that's what the stock market uses to justify prices going either higher or lower. The first chart looks back. This is the TTM, or trailing 12 months. It goes all the way back to 1980. On this chart, we have the black line, which is the S&P 500, and then we have a PE ratio of 20, 15, and 10. These are static numbers that produce static values, and when we're above or below those values, it can help us to determine if we're expensive, fairly priced, or cheap. Right now, when we look at the S&P, the black line, we're well above the red dashed line. That's a PE ratio of 20. So on a historical basis, the market is considered to be expensive. We can also see more of a blow up of that same calculation where we take the price of the S&P 500 and compare it to the PE ratio of 20. When we're above zero, that means that we're expensive. We can also look at this in the context of different events that have happened going back to 1980, the different things that were occurring at that time, and then what were the valuations at that time as well. And you can see that we can go for long periods of time and be above the red dashed line. So we can be expensive for many years at a time. So we don't necessarily use this to make decisions. Our day in and day out decisions, we use other indicators to do that. But it's still helpful to know on a bigger picture, large scale, what is the valuation of the market, at least looking back. We also have another way that we can look at this, which takes an average over a period of time. This is the Shiller PE ratio, and currently the reading is at 29.45. Well, to get some context, the median and the mean is between 16 and 17. So we're just a little less than double more expensive what we should be necessarily based on a historical basis. So when people say the market's expensive right now, or whatever valuation they give, you can use this type of an approach to justify your stance. But the market looks forward, and these are much more reasonable numbers. But at the same time, these are based on forecasts and projections, and they can always change. They can be revised. Where past numbers, they shouldn't be revised unless somebody did something very wrong. But these forward-looking numbers, it's more, okay, we're just looking out into the future and trying to come up with what we think the valuation will be. We still use that 10, 15, 20 scale, and currently the S&P is coming in with a forward PE ratio of 17.9. So we're above the 15 level, but still below the 20 level. We also keep an eye on the mid caps, which are a little bit less valued right now. They're underneath the 15 level at 12.9, but they're still above the 10 level. And small caps are at 12 right now, where they're above 10, but still below 15. So looking forward, the market is not necessarily overvalued. Looking back, it is considered overvalued. We put all of these on the same chart. We have the S&P, the mid caps, and the small caps in different colors on here, and they pretty much go hand in hand with each other. If one's going up, the other ones are going up as well. This just gives us the ability to see everything in one place. But then when we look at the small caps, there are two indexes that we follow: the S&P 600, which is the small cap index, and the Russell 2000, which is also a small cap index. That's the red area here, and it's on a different scale. One reason why I use the blue line, which is the S&P 600, is that compares everything on this 10, 15, 20 scale. Another area that we look at is growth versus value. When you want to buy low and sell high, those are growth stocks. We look at capital gains for those types of investments. When the market runs into trouble, or if you're looking at dividends or more established companies, then you might jump over and do value. In 2022, value held up better. So far in 2023, growth has been doing better. So we want to get some idea where we stand with this. The first thing we look at is a pure growth index, which is more like equal weight. Sometimes they're double counted, and some of the ETFs do a little bit of different calculation. This looks at more of a raw score for the growth index, where we have been seeing some weakness, but the blue line is above the red line, so we're still in a longer term uptrend. Then we look at a pure value index pure value index. Sorry about that. Love these take one videos where we continue to be in a downtrend and we've been showing some weakness. Then where it really gets interesting is when we take a ratio between the two. On top, we see where growth versus value is showing that growth is outperforming. On the bottom, we see where value is underperforming. And the reason why I look at a lot of different charts and do a lot of different calculations is because the index might be calculated differently. The ETF may be balanced in a different way. So we just want to make sure that we're seeing the same things at the same time. We look at some growth to value ETFs and it's showing that growth is outperforming. Here's an inverse showing how value is underperforming. Here's another look where it shows that growth is outperforming and then value is underperforming. Then we look at some different indexes where it shows growth continues to outperform. And then we have another measure that we look at using some different indicators. This is showing that growth is outperforming value. Now, the market's been having a difficult time in September and even into the early part of October. And to see this ratio going up is actually more positive for the market. Then we have an inverse of that same chart showing how value has been going down, even though we've been having some difficult times. We've been bouncing around in here, but value is now starting to decline a little bit more. We look at the small caps and we compare small cap growth with small cap value, where even though small caps have really been getting hit, you can see the price chart for the small cap index. We've been going down since the beginning of August, but growth has been holding up fairly well, and that could be under the surface more positive for the small caps. We're also seeing some underlying strength in the mid caps when we compare mid cap growth to value. Mid caps have been under a lot of pressure as well, but we've been holding up with this ratio and actually potentially breaking out above where we were setting a high previously, and that could be under the surface strength for the market. This is the one that I pay most attention to. This is the ratio between growth and value for the S&P 500, where we've been holding up fairly well, not really breaking out at this point, but we're not going down, and we are also in a longer term uptrend. We keep an eye on inflation. We have a monthly chart of the CRB index, which is starting to go back into an uptrend. And then we have inflation areas, and then we compare that with deflation areas and take a ratio. When this chart is going down, that means that inflation is not necessarily a problem according to the components that are used in this calculation. And we're declining below this moving average. So inflation seems to be going down. We look at the CRB index, and you can see over on the left, these are the different components that make that index up, where we have been seeing a pullback in the CRB, but it continues to be in an uptrend. The Baltic Dry Index, which has been in a downtrend, and it's still in a downtrend, but we're starting to spike up here. This is measuring how much does it cost to ship products from point A to point B, specifically in the Baltics. And this is likely going up because of an increase in oil prices. They have to pay to ship these products, and if this continues to go up, that could produce some inflationary fears. Some other markets that we just keep an eye on just to see where they're at current times. Aluminum continues to be in a downtrend, where corn is also in a downtrend. Wheat is in a downtrend. Fertilizer is ticking back up slightly, but it's still in a longer term downtrend. Oil, which has been kind of the talk, we got up into the mid 90s, and now oil is starting to pull back, but it's still crossing over into an uptrend. Gas, something that we all feel every time we fill up our cars or trucks, it had been chopping more or less sideways, and now it's dropping down and could be resuming a downtrend. Then we keep an eye on diesel. This is what railroads and trucks and different machines use to transport things, where we're seeing the price of diesel continuing to go up, even though it's ticking down just a little bit on this chart. Heating oil starting to get cold again, wondering, okay, how much are we going to have to pay to stay warm this winter? This has been bouncing back up and is starting to resume an uptrend. Natural gas, which is continuing to fall, and even though it's bouncing up, it hasn't resumed an uptrend yet. Copper, which is a barometer of the economy, when this is going down the way it is right now, that generally means that the market is anticipating economic weakness going forward. We also take a deeper look at copper because when copper is going up, the economy is usually doing better. When gold is going up, usually the economy is doing worse. The problem that we're having right now is both are in downtrends. So we look at a ratio between the two where copper is slightly outperforming gold, but we're not seeing really anything decisive right now where we've been chopping sideways with this ratio. Then we take that same ratio, which is the black line, and we look at it longer term. And we also plot the 10-year yield and the 2-year yield in both red and green here, just like the TV show, where typically for a number of years, they had a tendency to go in the same general direction. Well, now for the last year, year and a half, the spread has been really wide as we've been going through this strange time, and they're not necessarily going in the same direction. And we're wondering, is the economy still in that process of changing its character? Then we look at gold, which recently just had a death cross, and it's been really going down lately. And you've got a lot of gold people out there that they're like, buy gold, buy gold. Oh, buy it on the weekend, buy it even though the market's closed. Go to this website and buy gold. There's this urgency to buy gold. Well, every time something like that tends to happen, we end up seeing gold dropping. It's kind of its own little thing. And we're also seeing where silver is now continuing to be in a downtrend. We look at gold on the top, which are closing prices, and then we look at silver in the middle, and we can see at the bottom where this is a correlation, where it means that they have a real strong tendency to go in the same direction at the same time, which is not really a surprise. You generally say gold and silver together, but sometimes they can get out of line with each other. We also have a gold to silver ratio on the top, and then we have the US dollar index in the middle. And as a general observation, when the US dollar index is going up, gold outperforms silver. When the US dollar index is going down, silver outperforms gold. Well, the dollar's been really strong lately, so that would tend to indicate that gold should be outperforming silver, but gold's coming under some pressure, as is silver. And so how we get more of an insight from that is we look at the correlation on the bottom, and they're having a slight tendency to go in the same general direction. They had got out of line with each other just a little bit. And this is not necessarily to make buy or sell recommendations. This is just to get some insight as to what's happening. Then we look at the dollar index, which has now resumed an uptrend, both on the daily chart and on the weekly chart. We got up into the 107 areas on an intraday basis, but now we're down just under the 106 level. We look at the euro against the dollar, where the dollar has been going up, the euro has been going down. They're not quite at parity yet, which means 1 for 1 at the same price. But, you know, if you're thinking of going to Europe, now might be a fairly good time to do that because the exchange rate is more favorable. Then we look at the Japanese yen, which is in a downtrend compared to the dollar. We also plot the euro here and then the dollar index. Then I have a standalone chart of the Japanese yen, which continues to be in a downtrend against the dollar. When we were spiking up earlier in the week, there was some speculation that the finance folks in Japan didn't really like the idea that the yen was underperforming the dollar. So they may have jumped in and started buying yen like crazy and selling the dollar, but it really didn't have all that much of an impact on the overall market. And so this is continuing to be in a downtrend. The British pound to the dollar, it's still in an uptrend, but it's really pulling back. Again, you're thinking about going to England these days, we might be getting close to a death cross. Looking at some different indexes, we have the S&P 500, which is a weighted index, meaning that the big companies, the mega caps, when they move, they have more of an impact on the S&P 500. Well, to kind of get some more fair comparison, we look at the equal weight index where all of the stocks in the S&P are treated the same. When we're underneath the index, that means the equal weight index is underperforming the regular S&P 500, and that's what's happening right now, even though we're bouncing up slightly with the S&P in Friday's session. We look at a ratio between the S&P 500 and the CRB index, where The S&P has been underperforming, even though it's still in an uptrend, but it could be starting to bounce back up. It's still coming up to its 200-day moving average with this ratio. Here's an inverse of that exact same chart showing how stocks have been outperforming where the CRB has been underperforming. Even though the CRB is bouncing back up, now it's starting to come back down. We look at the NASDAQ 100 and compare it to the S&P 500. Now, we've been in a rough time for the NASDAQ 100 and the S&P 500, but overall, it's still up on the year. But when you compare the two with each other, the NASDAQ 100 is outperforming the S&P 500. We look at the S&P 100, which are the biggest stocks that make up the S&P 500, and the big stocks continue to outperform. We look at the NASDAQ, which has had a fairly good year, although some bumpy recent times, and compare it with the S&P, which also is doing well, but bumping around. And it's showing that NASDAQ, which is heavily tech-laden, is outperforming the S&P 500, which does have tech, but also has other value and other growth companies in it. We look at the NASDAQ 100 and the NASDAQ, which both are up on the year, but the NASDAQ 100 is outperforming the NASDAQ. We look at the mega caps. These are the really big companies, and compare it with the equal weight index, showing how the big companies continue to outperform. Then we take a ratio of the small caps to S&P 500, and this is a concern of the market. This is the ratio here is the red line, and it's really going down, and small caps have been under a lot of pressure. In a good, solid environment, we want to see this red line going up in addition to the S&P going up. If we're more negative, we would generally see both of these lines going down. The blue line here is the S&P 500 to get some perspective. We compare small caps with the S&P, and they're continuing to really underperform. We look at the biggest software companies in the US, where they have been under some weakness lately, and we could be getting ready to see a death cross here, but it hasn't quite happened yet. The mega caps, these are the big monster companies. They continue to be in an overall uptrend. We look at robotics and AI. That's what everybody seems to be talking about, but the ETF itself has not been performing well, and it's even been performing worse when we compare it to the rest of the tech sector. We look at the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together in one average, where we're chopping more or less sideways. We're still in a longer-term uptrend, even though we've been seeing some recent weakness. We look at the S&P 500 and compare it with shorter-term bonds that mature from 1 to 3 years out, and they're bouncing back up a little bit, but overall, they're still continuing to outperform bonds. Then we take a broad market measure and compare it with further out bonds, where we've been seeing some weakness here, but longer-term stocks are continuing to outperform bonds. Then we look at the low volatility index, which is really starting to come under pressure. It held up pretty well in 2022. Now it's starting to break down as we get into the latter part of 2023. We look at a ratio between the low volatility stocks and the S&P, where we're coming down and matching this previous low. We did see a little bit of a bounce up, but now we're coming down and wondering, are we going to use this as potential support with this ratio, or are we going to continue to fall? We look at the tech sector and compare it with 3 to 7 year bonds, where tech has been outperforming bonds. And then we look at the S&P with other stocks. We have an advanced decline line study here, where we take NYSE common stock, which is underneath the moving average. So it's negative, but it has been ticking back up. The S&P, the mid caps have been showing some improvement. The small caps, which have been a lot weaker, they're also showing a little bit of an improvement. Then we look at traditional Dow theory, where the Dow has been under a lot of pressure, even though it ticked up slightly. We compare that with the transports, which also have been under pressure. And what's really been under pressure, and what I include as part of traditional Dow theory, is we've seen utilities really under a lot of weakness, even though they're bouncing back lately. We look at the transports and take a ratio of that to the S&P 500, where we have the S&P on top. Now, when this ratio is going up, that means the transports are outperforming. And that's what we want to see in a more positive environment. But lately, the transports have been underperforming the S&P. We compare the Dow with the transports. When this ratio is going up, the Dow is outperforming. When this ratio is going down, the transports are outperforming. And we've been going up, meaning that the Dow's been outperforming, but now we're starting to come back down slightly. And we're waiting to see if some more strength will come into the transports, which would be more positive for the market. Just to keep tabs on what's the relationship between the S&P and the transports, we do a correlation down below. When we get a high reading like we are now, that means that they have a strong correlated relationship. We look at a new idea behind Dow theory, where instead of using the Dow, we use the S&P, since that's more stocks and a better representation of the U.S. economy. And then down below, instead of using transports, we use the NASDAQ, which is more tech, and that's more representation of the current culture that we live in. And we're not really seeing anything all that crazy right now. We're looking for positive or negative divergences or convergences that may happen in this chart, and they're pretty much following each other. The FANG index, which had come under some real weakness lately, it came right back up to its 50-day moving average in Friday's session. And FANG is Facebook, Amazon, Apple, Netflix, Google, and some other ones that changed the acronym around. I just stick with FANG. We look at a longer-term chart of the FANG index, where over the summer we set an all-time high with this index, and then we've been dropping back down ever since. We were keeping an eye on this as this index was running under some pressure. We were wondering, were we going to go back and take out this previous low, which we've set 2 times before? Well, later in the week, we started to see the FANG index recover, and now it's looking a little bit more positive. But this could turn and go down again at any time. We keep an eye on ARK, since a lot of folks are into that particular ETF. It's still in an uptrend, but we've been coming under some weakness, and we're underneath the 200-day moving average. Then we look at a monthly chart of the S&P on top, and then we have a long-term moving average here. When we're above the moving average and the moving average is going up, that's more positive. And we take a ratio looking at stocks outside of the US that reside in Europe, Australia, Asia, and the Far East. And it shows that the US market is outperforming the rest of the, at least world markets that we show in this ratio. We also look at a momentum indicator down on the bottom, the percentage price oscillator, or PPO, and it continues to advance above 0. So longer term, the S&P is still holding up fairly well. We compare stocks with bonds. We have a total bond ETF, which bonds have been under a lot of pressure based on price, and so now we're continuing to go in a downtrend. And world bonds, we're also going in a downtrend. We compare stocks to bonds on a monthly chart and take a ratio of that, showing how stocks continue to outperform. This is a shorter term chart showing how bonds are underperforming stocks. Then we look at what are called high yield bonds, and those we could also call them junk bonds, and they tend to follow the overall stock market. They're still in a longer term uptrend, but as we were running into problems with the stock market, we saw this going down as well. But the uptrend is still intact for the current time, even though we're below the 200-day moving average. And we look ahead at investment grade bonds. These are more conservative, not as risky, but they're in a downtrend right now. And then we look at the riskier bonds and compare them with more conservative bonds. The riskier bonds are outperforming. Now, if we were getting ready to have some real economic problems, we probably would not see this. And folks tend to prefer the riskier bonds because they give quite a bit higher yield than the no-risk government conservative bonds and even some of the more conservative corporate bonds. Then we do a ratio between stocks and bonds where they're having a fairly strong tendency to go in the same direction. If stock prices are going up, bond prices are typically going up at the same time. We look at the Dow Jones Corporate Bond Index, where we saw a recent death cross here, and so corporate bonds are under some pressure. We look at the 10-year yield, which has just been going up. We got above the 4.8% level during the week, but then we settled down into the 4.7 as we're seeing interest rates really going up. And then this is a longer term look at the chart. And I've been talking about this for quite a while, where if you go back to 1980 or so, and then you look at the long-term trend of the 10-year yield, we see a series of lower highs and lower lows, meaning interest rates have been going down. Well, we're breaking out, and we have been now back to 2022 into 2023, and we're wondering, are we seeing a long-term shift in interest rates as they continue to go back up? Now, this might not be the norm for what we've seen over the last 40 years, but when you take a bigger picture look and you go back into the 60s and throughout the course of time, we typically do see higher interest rates than what we've been seeing over the last generation or so. We keep an eye on the 30-year yield where it's continuing to go up, but it's still under that. It looks like 5% to me, but it's just under 5%. Then we compare the S&P 500 with the rise or fall in interest rates. This ratio is going down. That means that the S&P is underperforming the rise in the 10-year yield. We look at junk bonds, which again are still under a little bit of weakness. And didn't I just show this chart? Then we take a ratio where we're showing junk bonds, which are more risky and give a higher yield, and compare them with government bonds, which are more conservative and give a lower yield. And junk bonds are outperforming. And in a more normal environment, that's what you would see. Then we look at the price of bonds with the 7 to 10-year ETF, where we're down. The RSI is not necessarily extreme negative, but it is declining. We've had a death cross since August, so that's signaling that the trend is down. And we're also following the MACD, which is also in a longer-term downtrend. Then we look at a daily chart of the different yields going from the 30-year all the way down to the 3-month, and we're seeing a gradual increase in yields over time. And I chopped off some of the yield markings here. I need to change that for next time. This is a weekly chart looking internationally, where the U.S. had actually went back above the rates that were set in the U.K., but now we're seeing the U.K. rates starting to come back up as well. In blue are the German rates, and we're also seeing an increase in the Japanese rates. We look at the MOVE index on top, which measures the volatility of bonds. In the middle is the VIX, which measures the volatility of stocks. And then we keep an eye on the correlation between the two, and they're tending to go in the same general direction these days. If bonds are going down, stocks are going down, and vice versa. Then here's a monthly chart of the 30-year bond ETF based on price, and it's in more of a solid downtrend. On the bottom, we compare it with the CRB index, where bonds are still outperforming but starting to roll over. If this goes over negative, that could be quite negative longer term for bond prices, which means interest rates are going up. We look at different sectors in the S&P. The materials are underperforming the S&P 500 and are in a downtrend. The communications sector is one of the stronger areas in 2023, and it's continuing to do quite well, even with the problems that we've been seeing recently with the S&P 500. We look at the energy sector, which had been roaring back and gave us a recent golden cross here with this ratio, but now energy has been pulling back compared to the S&P. The financials, back in March, that's when we started to see the banking crisis happen. We've still been going sideways here compared to the S&P, and we're just wondering, is there more to come with the banking situation? And we look at industrials, which are in a downtrend compared to the S&P. The tech sector, another darling in 2023, even though it's been under some pressure lately, it's still outperforming the S&P. Staples, which are just getting hammered and really underperforming the S&P. Real estate also in a really solid downtrend. Utilities also in a downtrend. And then we take a ratio between the S&P and utilities. When this ratio is going up, typically the S&P is going up. When this is going down, typically the S&P is going down. And when this relationship changes, a lot of times that will mark a top or a bottom in the S&P. We look at healthcare, which is also in a longer-term downtrend. Here's another look at the ratio between healthcare and the S&P, showing that it's negative. We look at discretionary and compare it to the S&P, which it's been probably the third best area so far in 2023, even though it's been chopping sideways lately. The staples sector, staples are just getting taken out and shot these days. And we look at the tech sector, which has been under some pressure, but still in a longer-term uptrend. Semiconductors also under some recent pressure, but still in a longer-term uptrend. We compare the tech sector with the S&P, where tech is outperforming. And we look at the energy sector, which had been bouncing back, but when you compare it to tech, it's still underperforming. So energy continues to be weaker than the tech sector. We compare growth, which is buy low and sell high stocks, and compare them with bond prices, showing that the growth stocks are outperforming, where in 2022, they were chopping more or less sideways and having a tendency to underperform. We compare the tech sector with the 10-year yield, showing that the tech sector is getting ready. In fact, we're just seeing a death cross here when you compare it to the rise in interest rates. So that's a little longer term negative. Here's an inverse of that same chart where it shows that interest rates have been going up faster, or on a relative basis, stronger than the tech sector. We look at discretionary and staples and take a ratio, and discretionary is outperforming staples. And when we take an inverse of that same chart showing how staples are really underperforming discretionary, gold, which is supposed to have been to the moon by now, it's continuing to underperform the S&P, and it's also continuing to underperform the dollar. High leverage loans, and I say this in every video, these are some smart people that get into this investment, and they have a real feel for what's going on in the economy. If we were getting ready to fall off a cliff with the economy, would we see this really going up with this ETF? Probably not. Yeah, we've seen some weakness, but so far it's just come down to its 50-day moving average, and it could be showing some improvement. Now, if this really rolls over and we see a death cross here, that changes everything, but we've been watching this for quite a while right now, and it's still in a longer-term uptrend. The NYSE composite, been chopping sideways, seeing some weakness, but still in a longer-term uptrend. All stocks, even though we're coming back down to the 200-day moving average and rolling over a bit, the long-term trend is still intact, and that is positive. Emerging markets, though, we've been chopping sideways, and we're starting to get into a downtrend here. At the beginning of 2023, this was all the rage. Well, it didn't seem to last all that long, and we've been now starting to get into a downtrend. The microcaps, also a sign of concern. We dropped below 100 and we set a new 52-week low. We want to see the microcaps, the smaller companies, really doing well in a good, healthy environment, as we want to see the small and mid caps doing well also. We keep an eye on the home builders. We're on top. We have the S&P. We have the home builders ETF. We take a ratio between the two. And then what I look at the most is on the bottom, which is a correlation between the home builders and the S&P. And when we get down to a negative reading, that's when we really pay attention to this. When we get a high reading like we have right now, that just means they're going in the same direction. So we're not really seeing anything in this chart that's telling us much. Bitcoin, which just had a recent death cross, chopping more or less sideways. There's a chart that I've been showing in the daily videos put out by Stock Traders Almanac showing that seasonally, if you go back just the last few years, Bitcoin should see a nice bounce. But when you take all the years together, Bitcoin continues to go sideways during this part of the year. Looking internationally, where China is trying to turn back up, it's still in a downtrend. Emerging markets are under pressure. Europe is under pressure. Japan's under pressure. And the US has been under pressure. So we have a global phenomenon going on right now. Going back, looking to the beginning of the year and looking at InterMarket Analysis, where oil had just been screaming out. That's the red line, and it's really falling back. It actually replaced stocks as being in first place. Well, now stocks are back to being in first place, going back to the beginning of the year. The green is the dollar, and gold is pretty much flat going back to the beginning of the year. We went negative with bonds in early August, and we continue to be under pressure. Looking at some correlations, we take the S&P and correlate it to the dollar, and they're having a pretty strong tendency to go in opposite directions. So if the dollar is going up, stocks are going down, and vice versa. We compare the S&P to oil, which they're pretty much neutral now. Oil was really going up, and that was pressuring stocks. There are other times when oil going up is actually helpful for the S&P. Well, because it's more inflationary as it's being taken right now, that was pressuring stocks. And we're seeing this relationship changing just a little bit, and it's pretty much in neutral land right now. We compare the S&P with the 10-year yield, also a fairly strong tendency to go in opposite directions. And we look at the tech sector compared to the rise in interest rates, where they're going more or less in the same direction currently, which is kind of strange. They tend to spend more time going in opposite directions because tech companies have to borrow a lot of money. The more they have to pay in interest, the more that's going to bite into their earnings. We look at the S&P and then look at a correlation between that and the 2-year yield. This is also currently neutral. And we have some long-term secular, which can span decades, and cyclical, which can be years, trend studies. We have a monthly chart of the NYSE, where it has been seeing some weakness. The red line is still going up. We dropped just a little bit below it. So we could still recover from this, but we want to keep an eye on this chart. However, longer term, we're still above the zero line, but the Copic curve is starting to roll over slightly. Then looking at a daily chart of the NYSE, and then down below, we have the NYSE record high percent index. This has been falling back as the market has been under pressure lately, but longer term, it's still in an uptrend. Then we look at the S&P monthly chart, where we're still above this longer term moving average. That's positive. We're still in a longer term uptrend, but starting to roll over when we look at the percentage price oscillator down below. This could be longer term negative. We compare the S&P 500 with the CRB index, and even though the CRB has been doing well and stocks have been doing well, but under recent pressure, we're seeing where the S&P continues to be outperforming the rise in commodities. And then we look at the S&P and compare it with another global index. And this is a monthly chart where we're still above the longer term moving average. That's positive. The KST is negative, but starting to turn back up. That's another momentum oscillator. Then at the very end of the video, I take all the things that are positive, and my definition of positive is when the 50-day moving average is above the 200-day moving average. So first we have growth, the indexes and the ETFs. They're positive in and of themselves. The CRB index is still positive. The big software companies, even though they've been under pressure, they're still in uptrends. The dollar has just resumed a recent uptrend. The euro and the British pound compared to the dollar, even though they're under some weakness these days, the mega caps, those are the big companies. The Dow Jones Composite Average is still positive. The FANG Index as well as ARC. Bonds, when you just look at the high yield and junk bonds, those are doing quite well. Tech and the semiconductors, the high leverage loans, the Dow, the mid caps, and the small caps. Now, with the Dow, not so much with the Dow, but with the mid caps and the small caps, we've spent quite a bit of time under their 200-day moving averages. Another few days of that, and we could see a death cross with both the mid caps and the small caps. But for right now, they're hanging in there positive. The NASDAQ and NASDAQ 100 continue to be positive. The NYSE composite, all stocks as well. And then negative is when the 50-day simple moving average drops below the 200-day moving average. Value is still in a downtrend. Gold and silver are now in downtrends. Copper, the Japanese yen compared to the US dollar, the low volatility ETF, staples, the total bond ETF, world bonds, the micro caps, those are the real small companies, and emerging markets are still in a downtrend. We have investment grade bonds, or the more conservative bonds, as well as corporate bonds. And now we have Bitcoin, which generated a recent death cross. Thank you. I hope you found this helpful. Please feel free to check out the daily videos that I post, as well as the weekly video. I hope you have a really good weekend, and I will talk to you in the next video.